Welcome to the Second Bite podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Welcome back to the Second Bite podcast. I am excited for our guest today. Drew Bagot is with us, the founder and managing partner of Serata Capital. Drew, I'm excited for you to be here for a couple reasons. Thanks for joining us.
Yeah, thanks, Todd. Excited to be here.
Hey, I've wanted to, it's taken us a little while to get you on just because you've been busy. We had Matt Murphy, who's the founder and the CEO of Fusion 92 on. So for listeners, you want to go back and listen to that because he's one of your portfolio companies. And there's a couple main topics I want to get into today. One of them is, why did you like Matt? Why did you like the company? I think anyone that listens to Matt's episode will say that, geez, that's obvious, but it's less obvious when you're digging into things. And so I want to talk about that, number one. Number two, I want to talk about your firm because your lead investor, I guess I'll call it, is a family office. And I want to help people understand the dynamics, if any, that makes that a little bit different for you guys as you consider investments, how it makes you attractive or creates challenges for your portfolio companies, what it means for your length of hold and all that kind of stuff. Before we jump in, I do want to say thanks to our sponsor, which is now called Markham. Used to be a company right up the street called E. Cohen. They're now part of Markham. They're a great financial and accounting services firm. They've helped a bunch of my clients create their financial workbook so that we get the right value for their business and so that we're presenting it properly. So shout out to the folks at Markham and thanks for their support of the podcast. So Drew, why don't we start with your introduction of you and the firm, and then I'll get into just kind of asking questions.
Sure, happy to. I like to say my story is kind of boring because it's mainly me trudging along in private equity before going out on my own and sort of forging this path with Serata Capital Partners. But worked for a family office for a number of years, all in private equity, kind of straight out of undergrad, and then moved on to a large fund kind of run by a bunch of Goldman Sachs spin out folks, and very different from the family office environment. So I've worked in the family office side and on the fund side, and that may tie into some of the discussions we'll talk about later, kind of the pros and cons of both of those. And then I ended up starting a private equity group in a company called ORIX, which is a big publicly traded Japanese firm. And so we started their US, actually technically North America direct equity group. And then there was another strategy that spawned about the same time that was investing in fundless sponsors or independent sponsors, as we're now called. Still folks without a fund that are doing private equity deals. And after a while, those strategies ended up getting kind of commingled. And so that's how I learned about this model, was really by backing other independent sponsors from the capital provider side. And then I realized, my passion for PE was really, getting to work directly with teams and solve problems and roll up my sleeves. And I think, at my heart, I'm kind of an entrepreneur that just doesn't want to do one business. I want to do a handful. And I can get more into what we're doing at Serata Capital Partners that's different from a family office or from, a dedicated private equity fund. But that's what drove me to make the hop. And so for the past 7 years have been basically pulling capital together predominantly from family offices, although not necessarily, and we can talk more about that, where, I see Serata as a perfect stepping stone to being able to get absolute maximum value for your company. So usually we have our founders rolling, 30 to 49.9%, and do have the option to potentially go minority investment for specific circumstances. But it's really where we're helping, founder team solve all of the challenges, whether it's M&A, ops, or otherwise, to really be able to, not to completely cornily plug Second Bite, but really have that second bite be hopefully a multiple of the first, right? So solve those challenges before we take it back to market.
So let's pack that just a little bit so that, because we've got some jargon and so forth in there. So most people think about the world as private equity. And in private equity, if we're to kind of create stratus there's private equity in what is known as a committed capital fund. So they go out and raise 100, 200, $500 million. And then their job, as they work for the investors, is to deploy that capital. Then there's, let's call them independent sponsors. These are, I'll call them private equity guys without a fund committed, but with a network or a group of people that know you, know Serata, know the kind of quality deals you've done in the past, and essentially say, Drew, whenever you got something, man, make sure we're on the list and we'll write a check. And then there's the search fund guys that are not interested in building a private equity portfolio. They're interested in buying into a company and then going there to run that company. So if you can you comment on that? And would you say that that's an accurate description of what you are as an independent sponsor? But could you take us behind the scenes just a little bit and tell me what that's like for you? Do you constantly keep these relationships with investors warm? And do you ever have a challenge raising the amount of capital you need? Is that easy and relatively quick? Go ahead.
Yeah, absolutely. I mean, the way that I would think about it, Todd, is it's really a spectrum across both committed capital sources and then, uncommitted or fundless or independent, whatever you want to call it, sponsors. So like most things, there's not really one or two flavors. It really is a spectrum. So maybe we start with the committed capital side. I mean, there are funds who truly just get kind of financial data and maybe show up to a board meeting, maybe don't on one end. And then there's the whole other end of the spectrum where, it's a dedicated private equity fund, but maybe they've got a lot of good operating partners, kind of ex industry executives from that field or whatever. Or sometimes it's rare, but sometimes the private equity folks actually have operated businesses themselves. One of the things that I did when I wanted to go out on my own and start helping is I actually founded and started a business that I operate today as kind of a family business to learn that experience. So I think that, there's two ends of the spectrum there. And it really comes down to how passive or active they want to be. And I think as a seller, it's important to think about, do you actually want help or do you kind of just want the capital and for someone to just show up and sort of check in on the financials? There's no right answer. I think it's not.
And that's a great point. That's not self-serving, because we work with plenty of guys that say, I know exactly what I'm doing and how I need to do it. I just need some capital to support my acquisition or growth plans. And I have others that have built a nice business at 10 or $20 million and are concerned about what lies between 20 million of revenue and 50 million of revenue, and having guidance from somebody that's done that before would be very valuable. So
yeah, absolutely. And I think we left off even of that spectrum. I mean, you could add on to the sort of the left tail of that, debt, right? So, I mean, you don't even necessarily have to bring in an equity investor. If you want someone to be even more passive, as long as you're holding your financials. I mean, there's debt solutions. There's a lot of solutions, and it kind of depends on what you want. To answer the second part of your question on the sort of fundless or independent sponsor side, as somebody that first was backing independent sponsors from the capital side, I saw, every stripe, right? And so there's guys that are basically buy-side brokers who feel like they can just get better economics, but they have no bead on capital. They're going to try and sign an LOI up and just sort of pray that they can go find money, and they don't have a network at all. We also saw guys, usually a little older further along in their careers, that were writing, 7-figure checks into deals and were running the show, but they just, they wanted to diversify their net worth and not put $10, $20 million into a deal, but they probably could have.
So quick double click on that.
Sure.
Is there anything from an entrepreneur's perspective that would tip them to the difference between the two? Like if they've got a few different offers, the guys that are just going to hope in a prayer that we raise the money, and the guys that can reliably get it?
I think, a lot of it's just a BS detector, to be honest, is kind of the first thing. Usually, a successful entrepreneur's built up a pretty good BS detector. That's part of it. I think it's also track record. And I think being able to ask the question, give me an example of when it's been difficult to raise capital or talk to me about the sources of capital. I mean, someone doesn't have a pretty crisp and confident answer, there's usually, some smoke there. I think, for us, it has not been a challenge, but it's just because for 15 plus years, I've been in this space and have been fortunate to develop a lot of good relationships with, funds, family offices and high net worth individuals. And so our capital structure, does not look like a raise, like where we're going out and it's, pitching new people. It's established relationships. And so in my deals, I typically had 3 to 6 times, sometimes a little bit more than that, coverage from an equity standpoint on what we need to do to get the deal done. And I'm truly selecting partners that are going to add additional value behind Serata Capital Partners to the deal. And then tiebreak kind of goes to relationship and just, how we think people are going to behave.
All right. So let's do this. So you've got now, you need $10 million for whatever the deal is that you're doing. You go to those relationships. Do you go to them with a signed LOI or do you go to them in advance of that?
It depends on the process and how much sort of proof that a seller wants for that LOI. My experience in the past handful of years, certainly after, forming the Serata Capital Partners brand, have not really had a lot of people that were worried about us being able to show up to the table with capital just because of the relationships that we've built. And I think we've got a pretty decent brand name now. Prior to that, we would have to, sort of show up with support letters, which I think if you're concerned, if you really like an independent sponsor as a seller and you're concerned that they may not have the capital, I think asking for letters of support from some of their partners is not a bad thing. But for us, we generally get an LOI signed up, and that's really just to protect our time because it's just hard for us to run down our capital partners and spend their time evaluating deals that we may not get signed up.
So so if you sign an LOI, you'll reach out to your capital partners after that. Probably from past relationships, understand these guys are not going to be interested because it took us X multiple to get this business and that others will love it. And so what do? You send them the LOI and the deck on the company?
Yeah. And it's a fair distinction there. I think we typically will have conversations with our partners because we're in other deals or we're looking at other things. And so it's not necessarily that it's totally cold just because, we will sort of have some of those conversations, but they're casual. It's not a formal, let's run this through your investment committee process and get it all wrapped up for a deal. But typically what we'll do is, we'll know which 3 or 4 or 5 groups would each be able to potentially write, the entire check for the deal, right? And that's a distinction. We typically have an anchor investor that writes the majority of the capital on our deal just so that there's not a bunch of points of failure to getting a deal done, which is another consideration for a seller with an independent sponsor. But we're doing it's not just sending over, materials from the investment bank and the LOI. We have done a full-blown financial model and underwriting deck that's, usually about the same length as a SIM would be from the investment bank. And that all goes over to our partners. And we usually, I hate to say it this way, but it ends up being kind of a contest between our capital partners who gets the deal.
Yeah. And do you is there an advantage to you to having 1 or 2 or multiple?
Governance is something that can be a concern for, some independent sponsors or some other sellers. Sometimes they want to know who ultimately kind of calls the shots. And you have to balance that. If you had 10 people each writing in your $10 million example, if you had 10 checks, then governance is really going to rely pretty solely with the sponsor because nobody has anywhere close to a control handle on that deal. However, they've also got to raise 10 checks and have 10 conversations with each one of those groups to get it all pulled off. So I think there's kind of a balance. We might do 2 or 3. For a $10 million check, we'd almost always go with 1. For a $50+ million check, that might be 2 or 3. Usually family offices or sometimes funds or high net worth.
So, so that's part's helpful. So your anchor investor you referred to is a family office.
Yeah. So, and I think I talked about it on the podcast with Matt and great partners. So would love to plug them. They're Calidant Capital Partners. It's a British family with kind of U.S. management out of Boston, and great team, great guys. I've worked with them on multiple deals. And
can you say the name again?
Calidant Capital Partners.
Calidant Capital.
They're fantastic. But it's not a sole source of capital. We do have lots of other family offices and funds that we'll go to with deals. So that there are some independent sponsors that kind of work solely with one capital partner. And I'll tell you, if you're going to pick one, they'd be toward the top of the list to be sole source with. But our model is to have a diversified base.
And so you have a diversified base, but in Fusion 92, is Landon the investor along with you guys?
Yeah, so we put in our own checks at Serata Capital Partners, and we also will bring in, I've got a network of folks that are ex-private equity operators, kind of a little cadre of folks that are writing, 6, sometimes low 7-figure checks into deals, and they just help me at Serata become smart on the deal. So that's a big component of the deal. Then we'll also bring in advisory board members, and sometimes those are identified pre-closing, and they'll write checks as well. But for the most part, the majority of the capital, especially on larger checks, will come from one or sometimes two family offices.
When a lot of entrepreneurs, and I can hear them in the back of my head, guys that I've worked with, a lot of entrepreneurs hear this story, their reaction might be, yeah, well, that's going to make the deal more expensive for me as the entrepreneur, or I'm not going to get as good of a deal if I went somewhere else. Could you comment on that?
Yeah, I have some strong opinions here, Todd. So I think that's not accurate. I've heard of some independent sponsors, and again, I put them on kind of the bad end of the mix, kind of the new folks to town in this business model that might do it, that would try and charge carried interest to the equity of a sponsor, of a seller. That should never happen. So
break that down for me. What do you mean by carried interest?
What that means is that typically, like the same thing in a fund, an independent sponsor will have, some kind of closing fee that gets rolled into equity at the closing of the deal, some low percentage of EBITDA that's a management fee. That's how they keep the lights on and pay for their time. But then there's carried interest, which is a percentage of the profits of the deal at exit. And a seller, in my opinion, should never have to cover or give away any of their upside and their rollover equity to a sponsor. It should all be coming out of the investor, the new money side of the equation. So there should be no economic impact, at least on that side. And I think there's a second part to the question.
I'm so glad you brought that up, because I don't even know that I'm supposed to know that if I'm an entrepreneur and I'm dealing with on my own, which a lot of times people do. But a carried interest like that over 4 or 5 years could be, depending on the size of the deal, $1 million or multiple millions of dollars, right? So that's pretty significant.
Absolutely. Yeah, we were looking actually at a digital marketing deal, and they were considering another group, and on a no names basis said, here's some of the terms, and that was one of the terms. And we said, look, that's just way out of market and really not fair. The reason that a sponsor would get carried interest is for making a return for their investors. The seller shouldn't be taxed. They're still working in the business and driving returns. Yeah. So I think that's unfair.
Good point. So let me ask you this. If I'm the entrepreneur, and let's do it this way, one of my clients, and I've got you and Serata, and I've got 2 or 3 others that are committed capital funds, what difference would I notice going through the process? You gave us a really good view behind the scenes, right? The back of the house. In the front of the house, what would I notice is different?
Yeah, it's a good question. So I think it depends as much on who some of the other committed capital partners are, as opposed to the independent sponsor, and then where the capital is coming from for the independent sponsor, right? Because again, not all committed private equity funds are equal in the same way that not all independent sponsors are equal. Different private equity funds or even debt shops will do much deeper levels of diligence than others. So that's something that you just have to evaluate. A good question for a seller is, walk me through specifically what your process is, and maybe send over a diligence list and kind of tell me what it's going to look like. What I'd say is a well-managed, seasoned independent sponsor, there really should be no difference in how the process works. And there's still going to be a quality of earnings. There's going to be one checklist. Like what we do that I think is a service to the sellers is we manage the checklist, not only for us, of course, for all of our diligence, but it's one list that we integrate with anything that might come from our capital partners, insurance due diligence, quality of earnings, legal. It's all on one list. So they're certainly not managing a different list from a capital partner behind us. but they're also not managing it for all these other work streams for other diligence providers. So that's one thing. I mean, I think depending on how close the relationships are from a capital partner to an independent sponsor that's going to end up working on the deal, you can see a little bit of a time lag, right? So if someone really is going out and they're just dialing for dollars and trying to find money, I think you will see that takes longer for the deal to close. It hasn't really been our experience, just because, again, we've got some pretty close capital relationships that already trust in our underwriting. So there's not a multi-layer underwriting process for the capital partner.
And so if somebody does a deal with Serata, you tend to be the variety of private equity that is more hands-on with the management team, right? Is that a fair statement for all independent sponsors?
It should be. I mean, the ones, so from a capital perspective, there is another layer of economics that's going to the independent sponsor, right? And so that's irrelevant to the seller, but there should be value that's added by the independent sponsor. So that's one thing I think, a reason that we've tended toward family office or really close fund relationships for our capital partners is that there's not two head chefs in the kitchen. There's really one head chef in the kitchen, and that should be the independent sponsor, and that's us, because there's trust and a really seamless kind of behind the scenes governance and decision-making process. And I think that's what we've been able to bring.
Because in your construct, you are now the majority owner.
We're the majority owner, and our partners trust that we've got, good decision-making, and we kind of know what we're doing. We obviously bring ideas and information and key decisions back. We make them as a team. But, in my family office relationships, my capital partners, I really can't think of a major decision ever where we weren't immediately aligned and seeing eye to eye right when the thing presented to us. So that I've been fortunate on that. And I do think it's just homework on your partners. And so that's a key thing. Your question, Todd, was also around being hands-on, right? I think that's kind of a tricky word, because as someone now that's started a business from scratch, having someone else come into the business and be hands-on is a little scary. The way that I would describe it is if you're someone that really feels like there's no more value to be squeezed out of a partner kind of coming in, it really is just a purely financial decision. That means your business and maybe where just the founders at personally, they're in a spot where they probably should try and sell as much of that equity as they can and move on, right? If it's a situation where, like in Fusion 92 as an example, such a well-run company, right? I mean, I can't say enough good things about Matt and the team that he's built. They don't need a lot of help operating. I do think we've been able to come in and, for one, bring some other best practices and ideas that, when you run a business one way for 20 years, fresh ideas are probably helpful. But that's not where we've added most of the value on Fusion, is on rolling our sleeves up and getting into deep ops. It's been a sounding board on ops, but it's more been on the M&A side. So we've run down, I think 2022, we did over 115 or so SIM level diligence looks at digital marketing agencies, which is a big component. We turned down a lot just at the teaser level. So we've run a pretty solid process to find other acquisitions, and we've acquired three companies under Fusion. That's our main value add, and that's something that I think would have been hard for the Fusion team to do on their own.
Hard might be an understatement. I mean, how much time did you commit to that to Fusion in 22?
If I added it up, I don't know if it would make me proud and kind of sad. Probably it was a lot of my year.
Because I think a lot of times entrepreneurs think, gee, so Drew's coming on board, he's going to be hands-on, but he's not going to be hands-on doing your stuff, right?
Exactly.
Because to grow from 10 to 50 or whatever the numbers are, you need more hands, not less. You don't need more people doing the same tasks. There's different tasks to get to a different level, right?
Yeah, absolutely. And I do think too, there's a lot of dating and marriage analogies in M&A. And I think they're usually almost all pretty apt. And if there are red flags on how you get along with someone during the negotiation process, and I think it's worth talking about, what do you think your business strategy would be for this business, before you close the deal? And if you're not seeing eye to eye on a lot of stuff, that's probably after you get married, the problems are usually not going to get better.
Right.
So, I mean, I think that's very true of the process too. And so I think having a mutual respect for making sure that you're really aligned and kind of think alike, to a healthy extent is important. The other thing that I want to add in here that's important. So there's some perceived disadvantages from a capital perspective. I think a well-networked, good access to capital independent sponsor should be able to close a deal with theoretically even more certainty perhaps than a funded group, because you've only got one investment committee you can fail on. Theoretically, on an independent sponsor deal, that same fund could pull the plug and we would have another backup sitting there and still get the deal done. So I think there's obviously there's no capital there to pull down. So there's a different risk, and it's about underwriting the group. The one area of alignment that is, I think, irrefutably on the favor of the independent sponsor model is if you've got a private equity fund or even a large family office and you've got a team managing, let's say, 12 companies, the 80-20 Pareto principle will come into effect if you spend 80% of your time on the 20% that are probably the most challenged. There's an equation that all funds and large family offices will run. They'll say, look, at the end of the day, if this one's a loser, like we should just kind of cut it and move on, because it's going to save our time and free us up to another deal, and the fund will do better by letting this deal die on the vine. Well, for an independent sponsor, we don't really have the luxury of letting any one of our deals die on the vine. So there's better alignment and more hustle and usually more attention. What we're doing at Serata is we're kind of setting, for at least kind of the team that I'm envisioning being here over the next handful of years, kind of a 4-platform company, so specific industry maximum. So we're not pulled more than 4 ways. And I think that's an advantage, because not necessarily being hands-on and in the weeds in areas we shouldn't be, although that does happen. So do your diligence. Right. But it's more about being supportive. So when somebody says, hey, look, I've got an issue, or I need an introduction to someone, or do you have a system or a referral to this, or let's find an M&A target here, you're one of 2 or 3 or 4 instead of 1 of 12. I mean, that's where that makes a difference, and we can't afford for a deal to go bad.
Yeah, that makes a big difference. All right, so let's shift a little bit. And again, for anybody that hasn't listened to Matt's episode, you can Google Matt Murphy podcast, or just search our website at secondbitepodcast.com. I know Matt had multiple choices, right, in terms of picking who he wanted his financial partner to be. And I don't want to necessarily go into that, but I know you see lots of opportunities. You have 4 slots. So there's something that you saw in Matt, and we don't have to talk necessarily about him specifically, but I guess my question is, what does an entrepreneur need to do to prepare themselves well, or to be attractive, or to be a good investment? What are the attributes that you look for that maybe Matt demonstrated that made you comfortable committing the capital, time, energy, effort, resources, relationships to turning Fusion into something significant?
Yeah, absolutely. I mean, there's a lot of ways to answer that question, and I probably answer it differently for different deals, because sometimes the industry is, as attractive or more than the management team or whatever. So every situation, every business is obviously very different. I think, from a digital marketing and similar kind of professional business services model, I think a lot of what I'll share about Fusion 92 is probably accurate. I'll tell you from just a high level, robotic numbers perspective on the deals, we're always looking for high revenue retention rates of clients, low employee turnover, and then some angle in what they're actually very good at, because we all know it's enticing as an agency or a professional services firm to say you do everything, but usually there's 1 to 3 things you do really, really well: type of client, type of service, and to try and figure out, is that the DNA of the firm? Is that aligned with something that we think is a good growth area and that they've got a good strategy to pull market share? And so those are the 3 main things that we're kind of looking for is, again, revenue retention rates, employee retention rates, and then some kind of angle or secret sauce for the service sector that you're in. So
and just quick pause there.
Sure.
Do you have the exact same criteria? Because you've looked at a bunch and you've done only 3 with Fusion as far as tuck-ins. For a tuck-in acquisition, or do you look for the same things, or are you more looking for a service element or something different from that perspective?
I think it's really still those three things. The layer that we put on top of that as an add-in would be making sure it's a service and a team that we think will gel well with the mission of Fusion 92. As a platform company, it just needs to be something that we believe in, and usually a little bit larger business. But for a tuck-in, like for Fusion 92, save for maybe a couple of areas that we've identified we just don't need to be experts in, that are better just sticking with a third-party agency for our clients. We really want to be best in breed across pretty much every major service offering that you would get from like a holdco level agency, but do it at a size where we can actually put in the hustle and the time and the attention to clients that aren't necessarily AOR for a Fortune 50 brand, right?
Right.
And so for us, there's some specific areas that we've been targeting to really make sure that we're walking the walk on being best in breeds. That's another layer. But at a high level, the short answer to your question, Todd, is yes.
Since we've got listeners here, is there specific capability sets that you're looking for currently with Fusion?
Yeah, the areas that we'd like to build out more are really digital transformation and data analytics, data science, and a couple of other areas. But we are opportunistic. And again, there are lots of firms that have aspects and elements of some of those that I mentioned, and then some others, right? So it is a little bit hard to untangle until you get under the hood sometimes.
Yeah, got it. All right, so let's go back to Matt. To Matt. So what was it that you saw there in that business where you knew, obviously it's the three categories that you're checking the box on. What else kind of drove you to making that investment?
Yeah, absolutely. And those three are, like I said, that's kind of the robotic check the box. That's a gate, right? That means that we're going to continue to look at it. I think with Matt in Fusion, for one, Matt just as an operator and a salesperson, business developer, manager, just a stellar guy, but just stellar business person, right? Anyone who watched his podcast with you could probably sense that same thing. So there's definitely intangible kind of human element that's really important. You kind of know it when you see it in just high quality operators. I'd say in particular, Matt was very thoughtful about having a multi-year strategy leading into wanting to have a private equity partner. He was very bullish on keeping a large percentage of equity so that we remained aligned. And he had a clear vision on why he wanted a partner to hustle with him and run this M&A strategy. So I think having a clear reason other than I'd like to have a lot of liquidity and a real plan of like kind of leading up to a partnership and then post partnership and the why behind it being very crisp and well thought out and strategic, that was very appealing to us when we were looking at Matt and Fusion.
Can I ask you, a lot of times I hear from private equity guys that they want the entrepreneur to roll forward a meaningful sum of money. How do you determine what that is? Because, for some people, and depending on the cap table, the percentages could be different. I could roll forward $2 million and that could be, very meaningful to me. I could roll forward $5 million and it wouldn't make any difference to me. How do you guys try to determine that?
Yeah, it's a tricky question. It depends on stage of life, how many partners there are in the business, how long the business has been at the level of profitability that it is. So kind of what we can assume they have sort of set aside already. So those are all factors. There's not really a one size fits all. You can't pay your bills with a percentage of equity. You can only pay for it in dollars. But I think as humans, we're kind of wired to think in terms of that percentage ownership, especially as business owners and founders, where on day one, you're 100 and then you sort of work your way down from there. So I do think the percentage test, even as a group, so even if there's 3 or 4, founding shareholders, as a group, if they're saying, for us at least, we kind of start to get excited around 33%. And that's a probably higher number than average. I think normally you hear 20. But we kind of think of it just simple psychology. Like if you're keeping a third of the business versus keeping over a third of the business. We love it when somebody's excited about saying, look, like we want to keep close to half of the company so that when we sell this thing, we're truly betting on, taking chips off the table, taking on a little bit more risk, being a little bit more strategic, putting our foot on the gas with some help from folks that have done it before. But since we believe all that, we don't want to be looking back saying, geez, I just got whatever I got in the S&P or the debt market with all this cash. And I could have had it, in my partnership with Serata and done way better. So,
yeah. So this has been a great episode. It's helpful to understand behind the scenes, especially from somebody that has been in private equity for a long time and is now an independent sponsor and has had successful investments and round trips, as we would say. So, Drew, it was great having you to give us the other side of the story that Matt shared with us. So thank you very much for being a guest. Thank you to our folks at Markham for being a sponsor of the podcast. And it'll be great to watch you and Matt as the business continues to grow and improve.
Absolutely. Happy to do it, Todd, and great to chat with you as always. I appreciate you having me on. And yeah, let's do a follow-up segment on the other side of our...
I would love to do that. Thank you, Drew.
Appreciate it. Thanks, Todd.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.